All right, how are flows set up and what's going on? I mean, are flows really turning negative with the market turning down? Cameron Brandt is Director of Research at EPER Global, and he's, of course, the best person to put that question to. Cameron, great to have you with us here. Thank you very much. So far, what have we seen? I mean, it's just been a few days, right? I mean, a couple of days in the US and around the world that we're starting to see a bit of a pullback. And the question top of mind is this just a routine pullback or perhaps a bigger fall ahead? Can we answer that question looking at how flows and positioning is?
Yes, the rally we saw, certainly from a fund flows perspective, was not heavily supported. It had some of the characteristics of a summer rally where a relatively modest amount of money can move asset prices more than perhaps more heavily traded periods of the year. And I'm certainly sort of seeing the turn downwards we've seen in the past couple of days as sort of part and parcel of that general pattern.
Okay, Cameron, hi, good morning. You know, we've seen quite a bit of inflows into Indian markets over the last 1 month. Do you have any data to support whether, you know, this has been ETF-driven inflows or more of a, you know, sort of long-only money?
A little bit more long-only. India's been attracting certainly over here, some very favorable investment bank commentary recently, and it certainly hasn't hurt that India's the economy you're most frequently measured against, which is China, has sort of run into definitely a sticky patch. So we've seen a definite uptick in interest in India with funds based outside of India and with more of a long-term perspective.
Okay, so you're saying that India has been attracting favorable investments from foreign investors. In the emerging market basket, how do you see the trends shape up from here? There's been an inflow of about $20 billion already into emerging markets, but do you expect that inflows could continue, and where does India feature on that list?
So I think they can. We're certainly seeing the start of a reassessment of the sell-off that emerging markets have seen for multiple good reasons. What we tend to see in those early stages is that investors seek either diversified exposure through the global emerging markets funds, or they head towards the big five, India, Korea, China, Brazil. Well, actually, it used to be Russia, but that is obviously not the case now. So I should say at the moment it's the big four. We've definitely been seeing that. Brazil, as well as India equity funds, taking in, I think it was sort of a 4-month high, last week's flows into dedicated India funds. There was a notable spike in flows into both China and Brazil equity funds as well.
Right, you're saying that inflows into India dedicated funds last week, the last set of data that you have, was at a 4-week high.
More than that, I think an 18-week high.
Sorry, okay.
So yeah, so there's probably been a noticeable increase in interest in the biggest emerging markets, and obviously India is a paid-up member of that group.
Right. No, so, you know, you mentioned the big five, right? And you said, well, it used to be 5 at least till Russia was there. But should it, I mean, some are saying that even out of the 4, should it actually just be 3? It's just a hypothetical. Because of all the problems in China, are we seeing any of that dramatic sort of movement in flows, etc., you know, with respect to China? And how will that behave? I mean, what will happen if there are outflows from China? Does it get reallocated to other emerging markets or goes into GEM funds? Yeah.
Right. No, a very good question. What we've been seeing so far is more focus on the collateral damage than China itself. There's still certainly from the institutional flows that we track an assumption that China has both the political will and the fiscal firepower to keep this current pullback at manageable levels. Where we've been seeing China's current issues show up is in flows to funds dedicated to markets like Japan, which relies on China now for a fifth of its exports, and a lot of the smaller Asian markets, which are also, now in a position. It used to be said that when the U.S. sneezed, the rest of the world caught a cold. Certainly now China's relation to its smaller neighbors sort of somewhat fits that particular way of looking at the world.
Cameron, are you starting to see outflows from the commodity-driven markets given the rise in the dollar?
Yeah, in fact, we have not really seen any strong movement this year towards either commodities or energies funds, which, given the inflationary environment and the pricing power that some of the sort of key names in those sectors have found themselves with, is a little bit surprising. But I think that by the time sort of sentiment adjusted to that new reality, investors have also or had already started to look forward to less dynamic economic growth, and also a response to pretty rapid government intervention in some of these sectors. In energy, we've seen efforts to cap prices, Mexico trying to, or moving towards renationalizing its energy sector. So I think, somewhat to my surprise, we've not seen strong flows into those fund groups for most of this year, but I now think that the forward picture suggests that that's, not an unreasonable position to take.
Cameron, I didn't quite understand your view, what you said about China. Are you saying you're seeing outflows, or you're saying flows are suggestive that funds will stay put?
What we're seeing at the moment is that people are sticking to their China positions, but they are responding to the events there by cutting exposure to markets that are likely to feel real pain if China's economic issues persist.
Okay. All right, Cameron, we leave it at that. Thanks a lot for joining us and giving us a quick check on all that's happening as far as the flows are concerned. Let's slip into a quick commercial break. On the other side,